Welcome, everyone. Today we're covering Chapter 8, Capital Budgeting, Planning, and Decision Making. This chapter is about long-term investment decisions. In managerial accounting, one of the most important responsibilities managers have is deciding how to invest company resources in assets that will benefit the organization for many years. Capital budgeting decisions include purchasing equipment, opening new locations, buying new technology, or upgrading facilities. Because these decisions require large amounts of money and the benefits occur over many years, companies must carefully analyze them before committing to an investment. Here are the learning objectives for Chapter 8. By the end of this chapter, you should be able to describe how managers evaluate potential capital expenditures and identify the data relevant to making a decision. Explain and apply the average rate of return method for evaluating and making capital budgeting decisions. Explain and apply the payback method for evaluating and making capital budgeting decisions. Summarize the concept of time value of money. Apply the time value of money concept to capital budgeting decisions, and describe how managers account for risk and qualitative factors when making capital budgeting decisions. Before we jump in, let's connect this to real life. This slide illustrates the power of compound interest. Compound interest means you earn interest not only on the money you invest, but also on the interest that accumulates over time. The earlier you start saving, the more powerful compounding becomes. For example, a 22-year-old who saves $100 per month can accumulate more than $1 million by age 67. But if you wait until age 32, you must save around $276 per month to reach the same amount. This is directly connected to capital budgeting because companies face the same principle. The sooner an investment generates returns, the more valuable it becomes over time. Before we begin, let's review cost behavior concepts from Chapter 7 that will be critical here in Chapter 8. Variable costs change with activity level, while fixed costs do not change with a level of activity within a relevant range. Understanding cost behavior is important because capital budgeting decisions often involve estimating how costs and revenues will change if a project is accepted. Let's work through Learning Activity 8.1. Remember, relevant costs are cash flows that will change because of an investment. Sunk costs are not relevant because they have already occurred. Opportunity costs are relevant because they represent benefits sacrificed. Pause here and work through the activity. Once you've finished, check your answers with the solutions provided in the back of Chapter 8. Let's move into Section 8.1. Capital expenditures are long-term investments made by a business to acquire, upgrade, or maintain fixed assets. Examples include purchasing equipment, building a new facility, upgrading machinery, or expanding into a new region. Capital budgeting is the process used to identify, evaluate, and select investments that maximize long-term returns. Because capital expenditures require significant resources, businesses must evaluate them carefully. Managers evaluate capital expenditures by following a structured process. First, they identify investment opportunities, such as a need for more equipment or a desire to expand operations. Second, they analyze costs and expected returns. This includes estimating initial costs, future cash inflows, operating costs, and profitability. Third, they select the investments that provide the best return and align with company strategy. Let's look at some examples of capital investment decisions. Architects may purchase specialized printers to improve design operations. Hospitals may replace older surgical equipment to improve patient outcomes and efficiency. A boutique store may invest in new kiosks to increase sales. In each case, managers must compare the cost of the investment to the benefits expected over time. The most important inputs are cash inflows and cash outflows. Cash inflows may include increased sales, cost savings, or tax benefits, whereas cash outflows may include the initial investment cost, maintenance costs, or operating expenses. Notice that many capital budgeting methods focus on cash flow rather than accounting net income. Figure 8.1 summarizes the cash flow categories. When analyzing a project, we identify initial investment outflows, annual operating cash inflows and outflows, and residual at the end of the project's life. These cash flows form the foundation of most capital budgeting methods.